Okay, I'm joined today by Sean Dubravac. He's the Chief Economist for IPC. Nice to meet you, Sean. Thank you for joining us today.
I'm glad you're here at Apex.
Yeah, I'm really glad to be here too, believe me. So, Sean, tell me a little bit about some of the activities you've been involved in. You essentially, one of your key activities is bringing out the monthly outlooks for the economic outlook for members and also the industry sentiment. Maybe tell us a little bit about both of these reports.
Yeah, IPC has a very robust industry intelligence group that provides industry research back to the to the industry, and so it is the resource of all of IPC member companies. We, as you noted, we produce an economic report each month that looks at not just the U.S. but also what's happening in Europe and in Asia. Right. We also produce an industry sentiment index, and again, that's a global report that looks at sentiment across regions for the industry, and we do that as well on a monthly basis. So a lot of very rich detail in both of those reports to help members navigate this very difficult environment.
Do you see a big difference in sentiment between the different regions?
We do at times, especially for certain questions. We do see companies in certain regions respond differently. As we look at some of the recent results, and here at Apex we're releasing the most recent report, there is wide agreement on certain things. Labor costs, material costs have broad agreement across the globe. Right. Everyone is feeling that pain point. For some other things, there are some varying details that differ across regions, but for the most part, there's actually quite a strong consensus. Right. Companies are seeing good order flow, and there's kind of general agreement that shipments are strong, orders are strong, inventories are extremely tight. As a result of higher costs and tight inventories, you are seeing companies report struggling with profit margins and some difficulties there. And the outlook doesn't change that much. They expect labor costs to remain high. They expect material costs to continue to rise. As we look more broadly, we think we do start to see a little bit of moderation there, that material costs appear to have peaked. Okay. They'll likely remain high throughout 2022, but it does look like we can expect some moderation in the months to come, and that will continue into 2023. Right.
I mean, labor costs or labor period was an issue pre-COVID. It's exacerbated through COVID because of the problems with the pandemic. But some of the other pain points you talked about, for example, the supply chain stuff. I mean, the cost of containers coming out of Hong Kong, coming to the US and things like that, they have gone through the roof. How do you see that playing out going forward?
Container costs are very expensive. And we think they've probably peaked. We think we'll see some moderation, but as I talk to Maersk and others, it's not something that gets resolved overnight, and costs are likely to remain elevated throughout 2022. We are seeing really good progress on some of the port issues. So if you look at the end of last year, just at the Port of LA, for example, we had a peak of over 40 ships sitting at anchor off the coast, waiting to get a berth in the port. That number has come all the way down, so we're close to zero now.
That's good.
On a daily basis. So we're working through that backlog. I think that's a very good sign. If you look at the U.S., for example, and it's not that different in other parts of the world, still very strong demand for trucking. As a result, trucking rates are up. In the U.S., they're up about 50%. Yep. And by my estimate, demand is up about 3 times what it was prior to the pandemic. So all of these things, I think, moderate in 2022, but it'll take well over a year to get back to pre-pandemic levels.
And you think it'll get back there? I mean, to the $3,500 container?
I think we can get back there if the shipping industry wants us to get back there, right? As we hit the pandemic, there was a sense that demand was going to be much weaker. So a number of the major shipping companies took ships offline as they worked on them, took them to to dry dock to fix or repair or modernize. And then as demand spiked higher, they brought all of those ships back online. So we're running right now full capacity.
Right.
Obviously, as demand slows, if we pull some of that capacity offline for any number of reasons, it will keep prices high. So I think it now comes down to, what do shipping companies want to do? Is there enough competition in that marketplace to keep capacity high and to bring prices down?
Okay. One of the other areas that's causing a lot of concern at the moment is inflation. It's rising across the world, really, but most notably in December there we had a 7% inflation in the United States. That's very concerning, because once it gets out there, it's kind of hard to put that back in the bottle. What's your view on inflation, and how do you see that developing throughout the rest of the year?
Yeah, as you pointed out, we had strong inflation rates year over year, 7% in December. What's interesting to me with that in particular number is about half of that is being driven by energy costs and new car, used car pricing.
Right.
Used car, for example, up 33% over the last year. New car prices up almost 12% over the last year. So as the demand for those categories in particular have been strong, and there's been constraints on supply, it's driven the prices higher. Also, we had a tremendous amount of stimulus, so they're willing to come out and pay those higher prices. I think, likewise, some of that will moderate, maybe not strongly in 2022, but as we get into 2023 and we start to see some regulation in the production of vehicles, we start to get the numbers up, then we'll see some improvement there. Right. Typically in the U.S., we're producing about 900,000 new vehicles every month. Yeah. So on an annual basis, that's close to 11 million vehicles a year that are being produced. Right now, we're under 9 million on an annual rate, so we're underproducing where we were pre-pandemic by about 2 million units a year.
Is that because of demand, or is that because of the supply chain issues?
That is all supply. So if you look at as we hit the initial months of the pandemic, you saw it drop significantly. So we went from producing about 900,000 units a month to producing 6,000 units for the month of March 2020, I mean. And then you saw that bounce back very strongly as demand came back, and it shot above pre-pandemic levels briefly. And then it started to recede as supply was constrained, and that caused us to drop down below this annualized monthly figure of about 9 million. So I think that will start to come back. I think some of that improves in 2022. I think we underproduced last year by about 2 million units. I think this year we probably underproduced by about 1 million units. So I still think that there's going to be some pent-up demand, but I think that by the time we move into 2023, that will start to recover. Obviously, selling more new cars helps us sell more used cars, because you have rental fleets and others that will be liquidating their fleets on a more normal schedule. Every year they'll be selling off some of their older cars, buying some new cars, and that helps replenish that that used car market.
There's also the EV industry is rising, and in some countries like the UK, where I come from, I mean, they've mandated that there'll be no combustion engine cars by 2030. So that has an impact on the secondary car market, because the car's going to be redundant basically in a few years' time.
Yeah, and also the auto manufacturers have made very strong commitments as well. Some of them committing to only EV vehicles by 2028, 2030. There's a Vietnam company, VinFast, that just announced that starting this year they'll only be producing electric vehicles, and then others committing by 2040 to only be selling electric vehicles. So there is a strong, not just from regulation within jurisdictions, but also among manufacturers to drive that.
Okay. Final question, Sean. There's been an awful lot of M&A activity in the industry. Do you see that continuing? I mean, I guess for private equity companies, investing in the electronics industry is a no-brainer. It's expanding by application all the time. The demand, as you said earlier, is very high, very strong. So do you see that continuing, and is that good for the industry?
I think it definitely continues. There's a tremendous amount of liquidity, so that's part of what's driving this. Also, there's a strong desire to find investable assets. Stock markets generally, on average, have raised 100%. They've essentially doubled from the lows that we set in March of 2020. Right. And so investors are looking for higher returns. They're willing to move into more risky assets. Private equity is sitting on a tremendous amount of liquidity that they're looking to invest. And so it's moving into every segment of the economy. Certainly it's hitting electronics, probably stronger than it's ever hit. I think the benefit is we're still in this very difficult operating environment where companies might have all of the pieces they need, all the components they need to produce a product, and then they're just, all of a sudden they get alerted that the one product they needed, the one component they needed, hasn't yet arrived, and now it's got a lead time of 4 weeks or 5 weeks. It's been delayed. Right. And so now they're sitting on all this inventory that they've had to pay for, but they can't get paid until they ship the product. So there's obviously a cash flow mismatch there. Private equity could come in and help. Right now, many companies have to rely on banks and bank lines of credit, but if they have strong private equity partners, maybe there's an opportunity for short-term bridge loans there. Private equity probably brings in some expertise that is useful, especially when it comes to finance. Maybe there's some synergies that can be created. I think the challenge is, what does it start to look like in 5 and 6 years? Where do these companies go? Do we see private equity trying to merge several companies together? So do we see it at the end of this? Do we see some consolidation? Do we see bigger, in some ways stronger companies? Do we see a modernization that also comes, where some private equity firms willing to invest for the long run? So that becomes another big question that we have to discover. And my sense is that there probably are some financial partners out there that are willing to invest in the long run and willing to help companies modernize in order to be competitive. We've got a lot of things in movement coming out of the pandemic.
Absolutely. I mean, but they really do have to sort of, as you say, look at the long run and not just the 5-year window.
Definitely. And we talk a lot about what's going to happen around regionalization, if companies are going to start to focus on regional markets and to alleviate some of the strain that the supply chain constraints have created. And, there might be opportunities there. We see it in Europe and the U.S. especially, where the production that's being created, they're really trying to focus on high-end, high-value, ultimately expensive, high-dollar value or high-euro value products that service not just their domestic market, but also could be exported and service the broader market. So I think there's a lot of opportunity. We're seeing electronics move into more things than ever before. So it isn't just growth of everything that we've seen over the last 24 months, but it's growth of all of these new categories that will be influential in the years to come. No, it's an exciting times for sure. So, Sean, great to talk to you about all of this, and I want to thank you for coming in and joining us today. Glad to be here.